Hello everybody, my name is Chris in Canada. I get asked a lot today about TNT REIT just because it's been hammered. People are scared and they know I know about REITs, and I have a hobby of talking about REITs and on Twitter and elsewhere. So TNT is a name that I have been following for about a couple of years now. I've followed it casually longer, but I followed it very closely for the past year. And I recently took a position. I first was intrigued by Daniel Drimmer's buying earlier in Q1 after they cut the dividend. So it was, TNT was a great dividend play for many years, but they got hit by the higher rates rather than weakening fundamentals. Both kind of happened at once, but I would say it's more the interest rates that hurt TNT than occupancy. So I did notice those huge buys by Daniel Drimmer at the beginning of the year. And that's something that I really like to look at when I come to investing, is insider buying. And Daniel Drimmer, if we look here, he's been buying ever since 2020. So he's been buying in like millions of shares. And, earlier when they cut the dividend, to see a CEO at 1 million shares and he was buying them in the 340s, it was, quite intriguing for me. So I did take a closer interest into TNT REIT. So TNT now is down to 134 per unit. That's $2 less than when Daniel Drimmer was buying in Q1. The implied valuation of TNT REIT right now is approximately 192 per square foot, which is ludicrous. The rebuild cost is around, in Toronto area, would be expected to be around 1,100, 1,200 per square foot. Toronto is the core market of TNT, and in that market, their prime properties are very nice Class A buildings in Toronto. So they do have Class B exposure in the rest of Canada, but these are secondary markets where you just don't have that competition that you have in Toronto, and you have no new builds. New builds now for office in many markets is at a 20-year low. They do have some major exposure to the British Columbia market, Vancouver, Victoria, which is the hottest market still in North America for office right now, and those offices are probably worth still, even in a bear market with high interest rates. The transaction market is going for between $400 and $500 per square foot. Smaller buildings are easier to sell than larger buildings, and several of their buildings are smaller buildings that would fit that criteria if they did need liquidity. Those markets are very strong still. You do have some very nice properties in places like I said, Toronto. Those are beautiful Class A buildings. That's actually where they've suffered with occupancy, I think, just because of the neighborhood averages. This building here, 400 Cumberland, they recently bought that in Ottawa. That's in the Byward market, very desirable building with ESG certifications. They used proceeds from a previous asset sale, I think from New Westminster, BC, to buy a more attractive urban property that fits their new strategy. So they do have some other properties also in Calgary, but they're very surprisingly secure tenants. This tenant here at 68th Avenue Northeast, that was a 2024 expiration. They just left. Well, they're going to leave January 1st, but TNT, to my research on Evans & Young websites, was able to find a new tenant for about 2/3 of that property already, so that's quite impressive, and they got them on a 7-year lease. You have this building, the weakest market, which is Calgary, 100% occupied by Alberta Health. Based on my research, that tenant is not about to leave, so the smaller buildings are typically one single tenant occupying them, like these ones in Shediac, New Brunswick, Hamilton, Fredericton. These are the bread and butter of the community. They're occupied by the federal government. I think that's a strategy by TNT. It's a very good strategy. These are imperative to the communities that they operate. You have some other buildings in Ottawa, which is a very decent market for offices, and they're not the typical offices downtown. You have like business park offices and tech offices that perhaps have mixed-use industrial capabilities to them, and they have ensured high occupancy, as you can see here with a building like this. A beautiful building in Victoria, I would say that's worth probably $450 per square foot. We're trading at $190 per square foot. Overall, it's quite something. So TNT's properties are relatively, I would say they're in high demand. They're not, and where you might have a weaker building, say one in Burlington here, that to me looks like a older Class B building. Just the land in these areas in places like Burlington and Toronto is being sold for $200 per square foot. You saw Mock Group earlier this year with Ceres Group buy approximately into a $200 million deal from AIMCO Pension Fund from Alberta and Toronto. They paid about $200 per square foot without disclosing the sales price. They said that land, that building is still still generating profit, but in a worst case, the land is worth more than we paid. So when you break down the fact that the land in these places like Burlington, Toronto is so expensive, and zoning rights, the residential zoning potential, it's ludicrous that a REIT could be trading for less than its land value in a worst case scenario. So I like TNT's portfolio. It's not as glamorous as Dream Office or Allied Properties. That has its positives and its negatives. But for me, it's more of a positive because the average, company is going to be looking for these kind of properties. It's not catering to a Google or an Amazon like an Allied, which has a correlation risk not only to a single market but also to a specific kind of tech tenant. So these are more broad use kind of offices in markets where you just don't have supply coming online, and TNT is usually quick to recycle assets that are no longer competitive. So they have done that this year. I have this property here at 340 Laurier West right beside them. You can see it in the pictures, 360 Laurier. The government left, they paid an early fee, and the whole building was sold to InterREIT for approximately 160 per square foot. And that will be turned into apartments. It's a 70s era B-class building, downtown Ottawa, which has been killed, and it's quite surprising. Just there's no people downtown anymore as there used to be on those streets, Laurier and Albert, and it's a very different city now. But TNT was swift to get rid of that. They took probably a minor loss on that if you factor in that it was rented out for 5 years after they bought it. But they did get rid of it very quickly. So the fact they're trading at 190 per square foot to me is absolutely incredible. So I get asked a lot about this REIT, and if we go on Twitter, we can see that people are looking at this, comparing it to Slate Office and AHIP Hotel REIT, both of which are in the US. I don't consider them comparable by any means. There's a lot of negativity. Price drives narrative, and people are quite scared. You can see right here, it's Slate Office is being compared to TNT, Innovis, another Euro-based REIT, which is a different kind of issue. So this is me, Chris, in Canada. I've been posting about TNT REIT for a while, and I don't reply to every single post because it's just, people have to do their own research, right? But there is interest, so that's a positive that people have taken interest in this REIT, which I never knew had so many followers till they cut the distribution. And in my view, cutting the distribution was quite a good idea, because the distribution at 20% yield was simply getting no respect. And when you're trading at such a big discount, it's very accretive to just buy back units. And I did write an email to management. I don't know, obviously they're very smart people, but I thought, why don't you just buy back units instead of paying a distribution that's not getting respect? I think other REITs should consider the same with buybacks. Dream Office has done it through a substantial issuer bid and minor buybacks through the dispositions earlier this year in Q1. Artis REIT has been doing it for several years with no success to the unit price yet, but I think that strategy will pay off inevitably as they continue their disposition pipeline project. So just to further continue about TNT, do we consider it a viable entity? Absolutely, it's a viable entity, right? So let's take a look and go through their Q3 just very quickly and review some key factors. So that's your percentages, mostly correlated to the GTA market, but you do have some broader Canada exposure, which is not really a bad thing. The Atlantic Canadian market is no new supply. Ottawa, no new supply. Alberta, absolutely nothing for supply, and they've been very aggressive in Calgary to get incentives to convert older offices to apartments. So that's something that is being thrown money at right now. It's going to tighten the market in Calgary, and as we know, that Alberta is having a migration boom from other parts of Canada for affordability crises. So Calgary is actually getting very, very hot, and we're in an oil boom again somewhat, and that's going to be great for Alberta. So if they do keep their exposure in Alberta, I would expect it to be strong. BC remains very strong. You can see their top tenants, very, very high quality tenants. You might not have the best pricing power there, but typically these tenants don't leave. So like I had previously mentioned, this one, which is coming due in 0.2 years, that's in December 31st or January 1st, that one has been released to a new tenant on a 7-year term. They didn't note that in Q3, but based on my research from the Avis & Young website, it did note that space has been released, and they're now multi-tenants instead of single occupied tenants. So very good for TNT. They have minimal releasing risk. I went through their buildings where you do have short terms to them, and based on my own opinion of reviewing the transaction market, if they can't release it, they're going to sell the building. And they're selling a building right now with no tenants. It's much easier than selling it with tenants, and it's very credit to the unit price if they do decide to do share buybacks or a substantial issuer bid, or simply pay the distributions out by special dividends, right? So there's a lot of ways that they can give money back to unit holders. So I would say TNT had a surprisingly good year. I think that the critics were quite surprised, and I know even a guy on Seeking Alpha, his name is Trav Value, very smart guy, was quite negative on the REIT to start the year, but he recognized that they had strong leasing this year. Not the best pricing power compared to other REITs, but still 11% increase in rents, and 422,000 square feet is quite good. So their lease rollover risk to me is very minimal. We start looking at it in 2026. That's where pretty much you're going to run into some issues if you do have issues, but you have a lot of time to decode that between now and then. And I would expect the market to tighten and macro conditions to improve by then, and rates likely to be lower. So TNT also has a very good for financing. They're pretty much done till 2025. You have a little bit left in 2024. TNT is still getting very good rates. They got 6% loans in Q3, so they've dealt with everything in 2023. We've been reading headlines that nobody wants to lend to offices, but TNT has had no issue getting any financing. It's getting new money that's the issue. And 6% is pretty damn good for financing in commercial real estate. The stories that apply to the United States are just not affected into Canada. You can't compare the two countries when it comes to commercial real estate, and that's something that is not well understood by the market. So TNT probably didn't have to cut the dividend. Fundamentally, you still had a very low payout ratio at 69%. That's with the absorption of the higher rates from the maturities of that have been refinanced at higher rates. So you would have seen that probably creep up in the next year or two when they have more rollovers next year. But you would have still probably been within the broader range and been able to accommodate that dividend. But why pay a dividend at 20% when you can buy back units? To me, that they made the right decision by canceling the dividend until April. If we look at their dispositions, I think that's quite encouraging. And I go deeper than this, but every REIT does display the dispositions, and you can see that they sold 3 dispositions this year, and this was the most obsolete property in their portfolio, and to get 160 per square foot was quite good. So for the REIT space, your interest coverage ratio is 2.43 times. That's getting lower, but it's typical with all names. All names have been, and many names are even below that. I think some names I've seen them down. Slate Office, for example, was 2 times. That's one of the worst in the industry. Now, one of the critics people like to say with TNT is that their indebtedness to GBV ratio is at 61.4. So yeah, that's elevated, but you have fixed rate terms. Most of them are lower interest payments. You just don't pay those loans off quickly. They don't really have floating rate debt. Everything is fixed, and it's encumbered to that asset, so you do get good rates. So they did, as I noted in the past, they did a lot of deals with equity issuances. So it's not all that they got is debt and bank debt. It's all lost equity, lost value over the years. That's good for new investors, not good for the ones that participated in the past. But it is the downside with TNT is that it's a leverage REIT, and 61.4, that's probably about 10-11% more than some other REITs, but it's not that alarming to me. And they have been doing gradual revisions to their property, where I think every 3 years a REIT has to analyze all their properties for fair market value, but they do that consistently. So I don't expect that number to get much worse on the GBV ratio. I think that's could go up a little bit just because of the rates, but it's not that bad, and I think it's under control, because these are fixed rate mortgages, right? And they also have that option of disposing of assets. And when you're trading so cheaply at $192 per square foot implied valuation, I just think that it won't take much to bring down the leverage should they decide to do that. So I wouldn't think too much of that. So they did cite that their NAV is at $4.97. So that's up to you to interpret. I would be comfortable in saying TNT REIT is worth 275 to 300 per square foot. I'm looking at it on a liquidation basis right now because space is so out of favor. Say $3 per unit to me would be more attainable in a liquidation situation, but when times improve, rates go down, I don't think it's far-fetched to expect to see TNT at $4 again. They are doing a reverse split, so you'll see $4 again soon, but times that by 5.75, so in the 20-ish range, 25 range, went after the reverse split, get back to where they were at the beginning of the year. I consider the REIT overvalued at the beginning of the year, but that was because it was a dividend stock, a high yielder, people held it for income. But to me, the real NAV is probably $3.50. That's something that's logical, but they say $4.97, so it makes sense to buy back units in any case, whether you consider it $3 or $5. Buying back units is the best way to deliver returns to shareholders in the longer term. So it is short-term pain for longer-term gain, and it's a brilliant strategy, and I like that strategy, and they made the most of a bad situation. So what else can we talk about? You know, the negativity on TNT is off the walls, like it would be for any REIT, but price does drive narrative. You can see the same nonsense. People tell me that Dream Office is going bankrupt. Dream Office is trading at just over 250 per square foot. That's Toronto prime land near the CN Tower. It's just unfathomable. So what else can I show you here? I wanted to show you there was a Raymond James report that came out today. They had put a 175 price target on there. Obviously that offers substantial upside. I respect Raymond James research more than a national bank who recently hit TNT with a downgrade because their occupancy was too high. They said that it will fall like other REITs because they're outperforming other REITs on the occupancy front. So after Q3, the same guy at National Bank, Matt Cormick, ended up upgrading TNT to sector perform. So I didn't see that report. I don't get their sell side coverage, but my friend at Raymond James, who's a financial advisor, was nice enough to send me this. I think it's a good reference piece, and investors can take mind with this because look at the valuation. It's just absolutely ludicrous. TNT units are trading at 2.9 times 2024 AFFO, 60% below our estimated NAV of 275 using a 750 cap rate and yield 0%. So the historical valuation of TNT REIT is just ludicrous, right? It used to trade at a much higher multiple. The average office is at 7.5 times, and they're putting that price target at 4.5 times, is currently trading at 2.9 times. So in any case, it's an unfathomable valuation, and it's tough to see downside here, especially when you consider that this REIT is able to liquidate properties if they needed the liquidity. Now, the price drives narrative, people think it's going bankrupt. And when we get into cap rates, they're using cap rate of 7.5%, and that's been something I've been seeing with all the banks. They've been upping the expanding the cap rates, but I would suggest looking at the recent dispositions in Canada that we can see that are visible and reported for office transactions. Artis is one that I think is a useful example. In this case, Artis had properties that were in Winnipeg. They sold them in Q3 using a low 6% cap rate, and those properties were lower quality than TNT's properties. So it is tough to sell properties. Larger ones are harder, and bigger ones that might be in the 100 million kind of deal, like you might have in Toronto with TNT's big, beautiful Class A buildings, those would be tougher to sell, but they're smaller properties. The 7.5 cap rate is probably excessive, so I would use a smaller cap rate than that, but perhaps say 7 to be safe, but it's not unfathomable to see transactions go even less than 7, even for office in Canada. The market is still strong, land is still invaluable, and there's a lot of variables. It's not just about, you know, how much income does that property generate, because they could have a different intention for the property. There's mixed-use properties and different zonings, and there's a lot going on in Canada, especially as we're into a housing crisis right now, and every level of government is throwing incentives out right now to developers to find a way to bring on new supply. That's a trend that I expect will continue, and we are seeing the fruits of that. So last thing I guess we could talk about just quickly is that TNT has initiated the buyback. If we look at SETI, I'll just show you how to use SETI. We'll go to True North and let's see what they came up with, and I want to show you that True North has started a buyback, so what to look forward to going forward. So we can see that True North Commercial REIT, that's the issuer. Today they bought 65,437,000 shares. I expect that they did that on an automatic purchase program, so we'll probably see this kind of transaction probably almost every single day until April or sooner. If they don't do that, they do have a right to do a single week block trade in which they can max out to a much larger number. But it may be hard for them to get big blocks because this one is really held, in my view, by retail traders. It's not really a big one with big investment funds, I don't think, especially since it fell below $3, which forced liquidations and of the people that might have held it for reduced margins. And then, they cut the dividend in April. That definitely didn't help. And then, now with the dividend totally suspended, that would probably hurt them in any kind of dividend fund that they do have a holding in. So I just expect these little transactions to persist, and over time that 65,437 per day will be 10% of the public float, so that's going to be very positive for shareholders who hang on. So the nutshell for me, TNT REIT is a very strong REIT for the office space. Price is definitely concerning when you see something go down like a rock. It is not a good sight to see, I don't think. But TNT's relationship with Starlight and, they have very deep experience in the real estate market for Canada, as I think ensured some success. To be honest, my biggest concern with TNT right now is that Starlight and Daniel Drimmer attempt to privatize the REIT at a low valuation. I don't know the legality of that because Drimmer is the CEO, but I do think that it would be in their intention to privatize the REIT. But that's not really that big a risk for new investors. It would be ones that are down, and then they might not see their money again if they privatize it. But anybody getting on now, it's tough to see downside just because the valuation is insane. But they've done a great job at managing the REIT. They've done it even now at a peak trial, to have a 93% occupancy rate and no trouble refinancing is very positive. So if you ask me, TNT is not going bankrupt. I think it's a good opportunity along with Dream Office and Allied. Each one has their own positives and negatives of why you would choose it over the other one. I think TNT is going to be a fantastic income play, and in the short term, you're going to have an unusual opportunity to capture significant capital gains as we're coming off a period of peak bearishness in not just the commercial real estate, but the office market. We're also coming off a cyclical top in interest rates, which has put a cyclical bottom in on the real estate stocks, in my view. And now we're into tax loss selling. And on top of that, they threw in a dividend cut. Well, we'll call it a cut, but it's really just a postponement until April. So you've had every single negative. It's hard to see downside here. Thank you for listening, and I would love to hear your views.